I won't ask for a pinpoint number, but I'm sure you can give me a range. What kind of range are you thinking about?
Well, the range isn't so important to us, John. It's more about, okay, what happens with earnings? Okay, so if earnings come down, and we've talked about this before, if earnings come down in a way that we think is appropriate with the path that we see, and we don't get a reset on price, then we'll just say it's over. Okay, so that could be here. That could be down 5%. It could be down 20%. Our work suggests it's going to be down closer to 20% from here. So clear low 3,000s. We don't have a crystal ball, obviously, but what we can confidently say is that the equity risk premium and the multiples that are being reflected do not reflect the earnings risk that we see. And we think the reason why that's happening is twofold. Number one, the economy is better, and people were not thinking that 3 months ago. I would say the biggest shift in that regard is, 3 months ago, most institutional clients thought that a recession was very likely. Now they're thinking it's not so likely anymore. So that's a big, sea change. And then, of course, this liquidity picture that we've been writing about and talking about, where global money supply growth has been more than offsetting what the Fed has been trying to do with tightening financial conditions, and that has created sort of an ebullient environment for asset prices. That's not sustainable in our view. But the timing of that's been a little tricky.
Mike, I'm sure you get a ton of questions about the October low. Based on everything you've said, obviously we don't have a crystal ball. A lot of people would lean on market history, though. How rare would it be if October was the low?
Well, okay, let's assume a few things. Let's assume that our earnings forecast is more right than wrong, meaning that the forward estimates have not yet troughed. It would be somewhat unprecedented from a timing standpoint let's say that earnings trough sometime this summer or in the fall when we think. It would be unprecedented for the market to have bottomed that far in advance, okay? But of course, we could be wrong about our earnings forecast, right? We don't, that's another thing. It's not infallible. But the odds are with us. The odds are, because our model is very much in gear. We have to go with the probabilities, and that's why we've been making the call we've been making, is that we just don't think the bear market is finished, because the earnings recession is far from finished.